Hello and welcome to Money, Me and COVID-19, where we meet with experts from the world of business, financing, investing and politics to understand what's really going on in this COVID-19 pandemic and how we can position ourselves to survive and hopefully thrive on the other side of it. My guest today is one of the most experienced analysts of the residential property market in the UK. He spent 12 years as research director at Savills, 13 years at Hometrack, and more recently, he's become the Director of Research and Insight at Zoopla. He's a member of and a fellow indeed, of the RICS, and he's been named by Property Week as one of the 100 most influential people in the residential market. His name is Richard Donnell. Richard, welcome to Money and Me.
Hello, great to be here.
So, yeah, well, 2020 was the year in which, we had an election, a new government, we were all steaming ahead with Brexit, all the uncertainty was behind us, and then along comes the Wuhan flu and lockdown and everything else. I mean, what is your data telling you the impact on the property market has been of these totally unprecedented events?
Well, you're right, it's certainly unprecedented, and I think when you lock down a whole country, a whole economy, and then you lock down a whole load of countries around the world, and given London, the UK, the centre of a lot of things globally, the housing market effectively went into hibernation, just like a lot of other businesses. We saw the demand for property started to fall before that, but over the lockdown period, we were having sales volumes at 10% of normal levels. People couldn't view properties. Interestingly, renters could still move into empty properties. And over the course of the lockdown, interest in property started to build off a very low base, but people simply couldn't view property. And then when the market sort of opened up on the 13th of May in England, we saw demands of jump off the scale basically. But over the period of the lockdown, it was very subdued activity. And I think what it's fair to say is the scale of the recovery we've seen since the lockdown ended has really taken everyone in the whole property industry by surprise. And there's probably caught quite a few economists off guard in terms of just how quickly, and this is the amazing thing, how resilient consumers can sometimes be, even when the economic clouds look very dark.
Isn't, to some extent though, isn't this the 3 or 4 months of pent-up data suddenly splurging into a single month? I mean, did you expect that to continue beyond the end of once the kind of backlog has been cleared?
Well, where we are today, so we're effectively almost 2 months on from when the English housing market opened, and there's two different benchmarks you can use. For the last 2 years, 2018, 2019, the whole Brexit debate has dogged consumer activity, interest in the property market. And you're absolutely right. Since the election, there's a huge return of pent-up demand. It's important to draw out the fact how weak London and the southeast housing markets were since 2016. So they've been, and what's happened is some of that rebound after the election was about London getting back up and running again, a little bit of relative value for money, affordability had improved slightly. So what we've seen since the lockdown ended is that, yes, demand has rebounded. Demand for housing, that's people emailing and phoning up estate agents about specific properties. It's not just idle browsing. This is people who really want to speak to estate agents. Demand for housing in England is still 50% higher than it was at the beginning of pre-COVID, and that itself was higher than the year before. So we have this position where demand for housing today, the number of people inquiring about property to agents, is almost double what it was this time last year. And so it is on the one hand pent-up demand, but I think COVID, and if you lock up 10, 15 million people or households in their homes, or 10 million households in their homes for 2 months, I mean, this is it's not even once in a generation. This is a once in a lifetime reevaluation of housing and what housing means to people. And on the one hand, you have young people who are renters who are trying to both work from home and Zoom calls off the ironing board in the bedroom while your partner's in the other room. And I think a lot of people have just almost reevaluated what their home means to them and what they want out of a home. And so what that's led to, I think, is there's a whole load of people who are in the market now looking to move, who probably weren't planning on moving at all before COVID. And this has been a catalyst and a trigger to actually move home. the only way you can really explain almost the unprecedented sort of increase in demand we've seen. And I think in the last couple of weeks, when the Welsh and Scottish markets have opened, they too have now seen a similar sort of takeoff in demand for property. And what's followed the demand, so demand, you need to see supply and sales following on. And so we have seen the flow of new inventory coming onto the market is now back up to sort of pre-COVID levels, about 20% higher than it was in March. And the number of sales being agreed, so this is sales subject to contract, so this is still 3 months away from the mortgage application, the legals and completing, but sales agreed are also running at about 18% ahead of where they were before COVID, and pre-COVID it was 20% ahead of last year. So the housing market is alive and well at the moment, and I think the changes earlier on the stamp duty are going to sustain that over the summer.
Yeah, we'll talk more about that in a moment, but it's interesting what you're saying. Certainly it's been a time where a lot of people have thought about their life, their career, their work. Also their companies have thought about that and thought, well, do we actually need to have these great big offices and be paying people to come in every day? So is there a change in what people are looking to move from and to compared to what we've seen in the past?
Yes, there is. I think there's definitely a sense that areas adjacent to big cities seem to be picking up more demand than the cities themselves. And if you take London as a region, demand in London is following the national trend. It's ahead of where we were pre-COVID, but it's clearly lagging behind. There seems to be more demand looking out of London than looking in London. I mean, London's still doing well. And I think you're seeing similar things in Manchester. I think part of this is, partly it's maybe first-time buyers thinking, look, rather than, if I don't have to be in the office 5 days a week and commuting is, I think people have reassessed how important commuting is in where they choose to live. And I think basically places where you probably wouldn't ideally want to commute 5 days a week to work are now sort of coming into play. So, we've seen a big increase in places like Canterbury, postcode area, Swindon, Northampton. I think people are factoring in the fact that I could buy a 3-bed home with that spare bedroom I could use as an office. It's got a garden, and people are now starting to factor in what their choices are between staying where they are, renting, commuting 5 days a week because there's no hope of buying in London, and thinking, actually, I'm now going to make the move and back the fact that hopefully I'll only have to be in the office 3 or 4 days a week rather than 5.
And I thought that kind of thinking must bring some almost structural changes in the market, because if you look back over the last few years, a lot of people were buying on the lines of Crossrail stations and things like that, where there's some big infrastructure project, because they thought they were going to be commuting 5 days a week. Now perhaps they're moving further out, and perhaps the premium around those stations and those areas might disappear because actually people no longer see that as a priority.
No, I think I do think there's a one-off factor here. I think there's this once in a lifetime. Never before have we had sort of 18 million homeowners and renters sort of reevaluating their homes. It's pretty exceptional. And I think part of what we're seeing is a one-off. I think you're absolutely right though about the sort of, it's the priorities of what's important to homeowners. It's the priorities, but I think again, I do wonder whether the pendulum has swung a little bit too far. It's sort of, because I think very quickly it will come around, is almost businesses accept they want to be flexible for employers, and there's a certain proportion of the labour force that is working flexibly. I think COVID's going to create another tranche of people who either want to or will demand to work more flexibly and where they work and how they interact. But I wonder, and again, this is very early days thinking, how does all that sit with businesses and what they need from their staff, and do we really want all of our staff only being in the office 2 days a week? There are things that offices deliver and certain ways of working deliver that drive productivity of that operation, etc. So I'd imagine over time, different businesses are going to look at sort of, well, where do we need our staff to be? How can we work efficiently? Probably there is a little bit of weariness of the sort of just one Zoom call after another. I was chatting to a colleague earlier on today. They've opened their office up and they're encouraging people to go back to the office. But some of these guys are going back into the office just to sit on Zoom calls all day, which they can frankly do from home. So we need to see how all this plays out. But I I think the prioritization of space, thinking about the fact that you might need to be in your home much longer than you were before, I think they're changes that are going to stick for now. But I think the commuting patterns thing is one that, and expectations of how much they need to be in the office is something that's going to play out over the next couple of years.
Yeah, I read somewhere that the new definition of middle class is whether you can actually work from home or not. And of course, that does mean, I think, obviously, certain kinds of work you've simply got to be there if you're in the hospitality sector or whatever, which kind of brings us perhaps more into the rental sector. And are you seeing a difference in the both the demand levels and the patterns of where people want to live in rental versus purchasing property?
Yeah, no, it's a good point. I think that the lettings market demand is also up significantly, but the lettings market saw less of a dip over COVID. It didn't shut down as much as the sales market because you were allowed to move into an empty property. And in England, in the UK, around about 100,000 tenancies end every month. And 3/4 of renters are effectively on rolling monthly contracts. So there's a lot of flex there where I do think people either moved out, down traded, went back to live with mum and dad. If you needed to save money, there's flexibility there. So we've seen the availability and the supply of homes for rent has grown much more than it has in the sales market. But the demand is still there. We're not seeing any major changes in what tenants want. I think there's a bit of down trading. I think the big story in the lettings market is the short lets market. There's been quite a big growth in people having properties they bought as investments, but then renting those out on Airbnb, on Home and Away, especially if you had your properties in areas where there's a lot of tourists and relying on the travel market. And so we saw the supply of rented homes really jump before the lockdown because the airline industries and the travel industry and the tourism industry really started to slow much earlier in early sort of March. So what we have seen is a lot more short let properties at high rents converted into long lets at lower rents. They're still expensive rents, but in some cases, the difference between a short let and long let rent can be 30 or 40 or 50%. So what we're starting to see is in some big urban centres, some rents being adjusted in line with the long let market. But I think at the moment in the lettings market, demand is strong. I think there's probably a growing amount of supply coming on at higher rent levels, and they're just going to need to find the right rent level to absorb or to be absorbed into the market from the demand that's out there.
Yeah, I mean, it's always so difficult with the property market covering so many sectors. But I mean, for example, anecdotally, I'm hearing from people with HMOs that, if you've got an HMO full of NHS staff, obviously you've been fine. If you've got an HMO full of hospitality staff, it's not been so great. So I guess it's the specifics of exactly who you're catering to are going to impact how badly COVID-19 has affected you.
Yeah, but I think interestingly, I think there's a couple of things really. When we look at rental growth around the country, to give you some examples, I mean, rental growth has really started to slow significantly in central London areas where, that sort of the international travel, moving around, is slowing. Whereas you're looking out of London, rental growth has hardly been touched. It's still running along at sort of 2% per annum. Go to Manchester, Birmingham, Bristol, all the big cities, rental growth is holding steady at sort of 2 to 3% in line with earnings. So rents over time track earnings. Interestingly, in Edinburgh, rental growth's been running at 5% for the last 5 years. Just because of affordability, I think growth in the short let market as well. So you're right, the rental market covers a wide range of sectors. I think anyone investing in rented housing, what they should really just want is the strength of the underlying cash flow over the long run. Rents track earnings, and a lot of people have been investing in property as of doing it as part of their pension provision. And what does every pension investor want? Well, they want an underlying asset that tracks sort of earnings growth. And I think investors just need to sort of take what the housing market gives them in terms of capital growth. And I think investors are sort of learning to love the cash flow as I describe it. I mean, that's what the joy of owning rented homes is all about. But obviously the costs of doing that, some of the regulation around doing that, and some of the tax changes have forced some people to sort of reconsider. And I think another thing that's going to support the rental market is because of those tax changes in 2016 around the tax relief and the higher stamp duty, we just haven't seen a huge increase in rental supply in the last 3 years, which is going to sort of protect the kind of downside on rent levels Whereas when we look back at 2008, 2009, we had the shock to demand, we had weaker demand, but we had a lot of supply coming onto the market. So excess supply dragged down rents by about between 5 and 8% over 08, 09. And I see, there's going to be some slowdown in rental growth, I think, but we're just not going to see the same sort of scale of slowdown that we saw over the global financial crisis.
I think I hear what you say about the data so far, but my feeling is a little bit like 2008. The full effects of COVID-19, I think, are going to take 12 or 18 months to feed through. And a lot of people who are currently furloughed will perhaps lose their jobs, sadly, and not go back to work. I know that they're trying to offer incentives to reduce that, but even so. So as you get this kind of increasing unemployment, that's surely going to have be a drag on prices. I can't help feeling that once we clear this immediate backlog, which perhaps even, as you say, dates back to the Brexit referendum and so on, that perhaps we're in for a softer market in 2021 than we're seeing right now.
Yeah, no, I think that's a fair summation. I think, again, what we're seeing at the moment is, given the strength of demand coming through, deals being agreed, it doesn't seem to sort of hit consumer activity. And look, it's different types of people here. Again, it's not all about first-time buyers. It's, it could be COVID could have created someone who's an empty nester. The kids have flown the nest. They're in a 4-bed house in London worth 1.3 million. And they decide, you know what, I'm going to go and trade out to that dream home in Wiltshire. And it's 700,000 and there's no mortgage involved and it just pays for itself. And I think I accept about unemployment and things, but it's, half of people own their home without a mortgage in this country. There's about 8 or 9 million people who own a home with no mortgage, and LTVs are low. But you're absolutely right. For the people who are sort of, their housing decisions are absolutely linked to their employment status. This applies in the rental market, the first-time buyer market, probably the second and third stepper market. Absolutely, I think people's consumer confidence over the economic outlook and their job prospects do have a big impact on the housing market. And the housing market is purely an extension of the economy. So if the economy doesn't do well, then the housing market doesn't do well. So I think, yes, we're certainly expecting demand to moderate over the second half of the year. There seems to be an expectation, and we've seen it yesterday, just a growing number of businesses making decisions about employment levels, particularly in the hospitality sector, the retail sector, etc. That's bound to play on market sentiment over the sort of final quarter of the year and into next year, basically. And I think that's going to, house price inflation at the moment is running at 2% year on year. It's pretty low by sort of recent standards. So it's not exactly house price inflation sort of running away, but yes, we'd expect sort of prices to sort of soften probably in the first half of 2021 at the moment. I think a lot of people thought, and economists thought, that house prices would fall sort of 7-8% year on year in 2020. I think that's unlikely. I think any price fall pressures is going to come through next year. And look, the government's gone a long way. The government can still go further. I think the X factor here is how far is the government going to keep going on supporting things? And ultimately, what's the taxation position going to be to pay for all this, and when's that going to fall? And we can't buy our way out of this crisis, but it's interesting just how far the government is going to support, particularly the housing market. And one other point I guess I'd make is 12 years on from the global financial crisis, we've still got Help to Buy supporting the new homes market, which was a sort of a scheme that was introduced at the time. So the interesting thing here is the level to which the government sort of interested or is prepared to go into supporting things.
Absolutely, and yes, I was going to mention that not only have we got this new stamp duty holiday, we still have Help to Buy. But I suppose the other thing that factors into this, of course, for a lot of people, recognising your comment about mortgage-free ownership, but for a large part of the market, their ability to buy relies on being able to get a mortgage at a certain loan to value. How are you seeing the banks and mortgage lenders responding to this crisis in terms of the products and the loan to values that they're offering?
That's a good point. I think most importantly is, so you're absolutely right, about 70%, 75% of people who buy a home a year are using a mortgage. And actually last year, around about a fifth of those people buying with a mortgage were using a mortgage at or above 90% loan to value. So over the last 2 or 3 years, banks have really sort of competed more aggressively in that sort of at 90. And a lot of it is at 90. It's not more than 90. The number of people taking a mortgage of 95% or more is absolutely tiny. It's low single digits. So it's more at the 85 to 90. And look, it's been well documented in the media that the availability of those mortgages has been reduced. I think what's not clear is how much of it is that to do with operational constraints, because lenders have been inundated with a new type of demand they hadn't experienced before called mortgage payment deferrals or mortgage payment holidays. So lenders themselves have issues with their teams dealing with COVID, social distancing, working from home. And, we've got nearly 1.9 mortgagees have applied for and got mortgage payment holidays. So the banks have had that demand. And what they did, they throttled back on the sort of slightly more higher intensity underwriting type products as higher loan to value. So we have got less high loan to value products available. I think really because of the way the banking system operates, you do need all the big lenders to be offering sort of in the market equally across all sort of LTV bands, because if one big lender's in there at 90 and no one else is, they just get inundated within the first hour of opening and they've literally done that day's quota. So the appetite's still there for the mortgage lending, but I think, the availability of 90 loan to value mortgages is really important in terms of how the housing market plays out this year. There are lenders in that 90 loan to value space. And again, a lot of it for them depends on their expectations of house prices and the impact of COVID, etc. So mortgage availability at high LTV is going to be a constraint on how many people can actually move home, a constraint on demand. But it hasn't totally dried up. But I think it's fair to say we haven't got enough of it to sort of sustain the level of demand there is out there. And I think banks will just also want to see how the economy plays out, what's the outlook sort of come the autumn time as they consider sort of the products they make available into the market.
No, it's interesting because there's so many factors here. I mean, you're a fellow of the Royal Institute of Chartered Surveyors, and of course, one of the things that can have a downward pressure on prices is if surveyors get a bit more conservative in their valuations on behalf of the mortgage lenders. I mean, from your contacts in the surveying and valuing side of the industry, what are they thinking about post-COVID-19 values? Do they see a potential for being somewhat more conservative?
Well, I think there was, and I think there was definitely the surveying industry. I mean, there's not a lot of pricing evidence. When the market's shut and there's hardly any pricing being set, life gets harder to value something. So there was definitely a growing, the error distribution or the sort of the range of uncertainty for surveyors certainly grew. I think there's a slight increase in the number of homes having a sort of small down valuations and price adjustments as people just took a more conservative view. I think the good news is, again, a lot of lending is into the 50 to sort of 75, 80% loan to value. So again, I think down valuations really have an impact when you're really pushing sort of high loan to value. And because we haven't had the really high loan to value 95% markets, down valuations had less of a sort of negative impact. But no, down valuations have increased. But I think with the pricing evidence now coming through, with sales rates back to where they were before COVID, with frankly probably evidence of quite, what I've heard is the discount between asking and achieved prices actually narrowed. It's not widened. But I think surveyors are probably getting more evidence now of sort of what deals are being agreed post the lockdown ending. And I think I would expect the level of down valuations to actually reduce in the short term. But look, surveyors are going to be cautious. They're going to be looking to the future. But when a surveyor values a property, they need to look at the evidence, the very latest evidence. And if the very latest evidence supports the price that wants to be paid for, then the sort of case for down valuing is more limited, basically. So I think down valuation should become less of an issue in the short term.
Okay, but I think we also need to look at the other side of the transaction, which is the property developer. And I'm certainly hearing from my own contacts, my own work in the investment field, that the lenders on the development side are more conservative and have reacted by kind of just rabbit in the headlights, freezing everything for a while. And of course, if you look back to 2008, a lot of property developers did go bust after that crisis. So I don't know at the moment whether it's too early to say, but do you have any sense at all for what's happening on the supply rather than the demand side, and whether developers are pressing ahead with projects or being hesitant and holding back on pushing the button at this stage?
Look, I think it's important to say that the property development industry is, it's very varied in terms of the business models, the funding, the types of businesses doing this. I mean, we tend to focus in on the big PLC house builders who deliver sort of 60 to 70% of the homes. I mean, they've got very strong balance sheets. They generate a lot of cash. I think, clearly those guys And again, the government didn't really want them to stop developing when the lockdown happened. I mean, some builders carried on, and with social distancing, I think most of the big builders have got all their sites open again now. They're carrying on, and actually they've got a lot there. They're sort of slightly struggling with the amount of interest for property at the moment. I think the challenge for the big house builders is actually completing the homes that they stopped building, getting the trades on site, getting the materials flowing again. But what I'm hearing is that there's not huge blockages on that. I think what you alluded to earlier is, where a scheme is, hasn't even started yet, and you're thinking about starting, and you've got various forms of funding from different people. Then, who knows whether funders will want to reevaluate schemes and make sure the kind of demands there, basically. But I don't think we're going to have an issue on the supply side this year. I mean, clearly builders stopped building for 2 months, which is going to have a knock-on impact. It's going to take them time to get up and running again. But I think, the building industry is sort of getting back up to sort of full capacity again, basically. And again, in London, I've heard that, developers, there's piling rigs moving on to, a whole swathe of sites where that hadn't been sort of progressed before that. So, of course, any bank is going to be, banks are going to be like any businesses, looking at the risks of lending and how much construction finance lending they want to put into a scheme. But again, banks haven't been really chasing high levels of sort of funding, certain levels of cost. They've been, a lot of the equity's been coming in from sort of mezzanine funds and other equity type investors. So the kind of traditional banking sector have not really been aggressively chasing finance. And it's a competitive market, but I think it's a blended funding model now for a lot of construction projects that sort of aren't done by the big PLC house builders who fund it all themselves.
Yeah, okay, that's interesting. And do you see potentially, we talked a bit about changing work patterns and so on. We know obviously before lockdown that the retail sector on the high street was struggling. Do you see the scope for some structural changes in how we use some of the buildings in our cities, like the office blocks where people are only coming in once or twice a week, the empty shops? We saw, Boris's build speech talking about wholesale changes to the planning system. I mean, do you think this could help us to actually finally overcome the structural shortage of new builds that we have in this country?
I think the shifting working patterns, a certain sector of the workforce has already been working flexibly. I think COVID's going to sort of create a new tranche of people who are able to work more flexibly and they can consider where they live. I think the pressures on the high streets have been around for quite a while, but again, different high streets have adapted in different ways. The office, there's still going to be demand for offices, there's still going to be demand for retail. I think this is just part of a progression of how our whole built environment evolves, how it's funded, the purpose it serves, its redevelopment, etc. And we've seen that for the last, it's been happening for the last 10 or 15 years. A lot of commercial regeneration projects are cross-subsidized or supported with housing elements. And so I think it's just the constant evolution of the kind of built environment in the UK that we sort of adapt and evolve. And, what you put on a site 50 years ago isn't going to necessarily always stand the test of time for what we want in the future. And, a lot of housing is delivered through regeneration schemes, mixed tenure development, etc. And I think that's going to carry on. And I think, COVID will create a shift in working patterns, but it's not going to be for the whole population, as you say. If you work in a hospital, you need to be near that hospital. Or if you work at a factory, etc. So it's just an evolution and a broadening out in the patterns of demand. And I think it's probably good news if we have less pressure on people all having to get on a train to come in 5 days a week to the office or on a bus or whatever. So there could be a benefit here for infrastructure, taking some of the pressure off some of the infrastructure we have around rail and road and transport, etc. more generally. So who knows? Let's hope we can kind of all work more flexibly, create that bit more flex in society.
But I have to say that coming back to the planning point, I think pretty much every project I've been involved in the last 5 years seems to have gone through inordinate planning delays, and you can't help but form the impression that the planning system is broken. Do you think these new announcements will actually clear that logjam and actually give us a chance to get a lot more building and new development done?
I think the planning system, and I think the planning system, George Osborne introduced a lot of changes, the new National Planning Policy Framework. They tried to, there's been a lot of simplification work around planning. And, a lot more permitted development rights for householders to do a lot more things that don't require planning. I think, planning it still takes time to get a planning permission through for complicated schemes, etc. There's still, planning will remain part of the challenge, but I think it's got much easier for the house builders I chat to. I mean, planning still remains a bit of a bugbear, but acquiring land's become less of an issue. The government have shifted the pendulum to being a bit more pro-development, in favour of development. If councils don't have their plans in order, there's a lot more sort of pressure on sort of being more pro towards getting development happening. But we live in a democracy. Local people need to have their say. The planning system is there to sort of ensure that developments happen in line with what local communities would like. And I say the pendulum has swung to being more pro-development, but that's not to say that big schemes can get delayed, and there's an ongoing planning discussion to be had. But I think things have improved. I think it's sort of, but I'm sure many in the development industry would love it to be much easier, but they just need to have that balance between developers and landowners that want to progress things and the impact on the local communities they're in.
So if Boris was to announce tomorrow that Richard Donnell was to be the 20th housing minister in the last 20 years, what kind of changes would you want to implement to actually address what you see as any constraints on the market?
I think the big one, we've got a liquidity issue in the housing market. People just aren't moving. The average household at the moment is moving every 20 years. The trend in the turnover of housing is downwards, basically. And there's a whole load of economic, demographic, structural factors on why people are moving less often. So I'd want to focus on, is this level of movement healthy? Is it impacting economic growth? Is labour mobility an issue? Is it putting extra pressure on our infrastructure, on our roads and our transport? So I'd be up for looking at policies and things that made sure that people could move if they could afford to. And I think things like stamp duty are an obvious one. And just looking at sort of how we get the right kind of homes built in the right kind of areas. So they're the things I'd be focusing on. I think the housing market needs to, we need to make sure there's sufficient liquidity in housing and households can move, and we can sort of support economic growth, to levels which the housing market can help the economy grow. So they're the things I'd be focusing on.
Fantastic. Okay, well, as we come towards the end of our time together, Richard, a lot of the people watching us are quite active property investors. If you, let's say you were sitting on a pile of cash and you are looking for the kind of property investment you want to make in the next few years, what would your what would be on your short list of things that would be a good property investment for the 2020s?
Well, I think, as I said earlier, I think that the housing, in terms of returns for investors, it's all been about house price growth over the last 30 or 40 years, because we've had pretty high nominal rates of house price growth. I personally think, if I was investing, I'd be looking at the rental growth. I think housing is going to shift between all the returns coming from house price inflation, with gearing in there on borrowings driving your return. I think it's all about the cash flow now. I think it's about focusing on markets that look almost under rented, or where rental demand will increase. It's almost taking all those commercial property principles of yields, levels of rent, potential for rental growth, drivers of rental growth, and applying those to housing. So I think housing is going to become much more like commercial, which is, where can I get, on the basis that rents track earnings over the long run, where can I get outperformance in rental growth, which are going to be those sort of the cheapest properties to manage. I think one of the big things to think about is the green energy agenda. If you read the tea leaves, it seems inevitable at some point we'll end up with some sort of what are called minimum energy standards for housing in this country, where you as the owner might have to invest money we don't think about today on getting your home to a certain energy standard. So I'd think I'd be buying family houses in good commutable areas to big cities outside the south of England with great yields. I'd be buying property types that I knew I wouldn't have to spend a huge amount of money on compared to other types of property. And I would just take the house price inflation the market gives me over 20 years, and I'd want to buy places where the cash flow was rock solid and slightly outperformed the long run average.
Fantastic. Well, that's great advice to end on there. Richard Donnell, thanks very much for joining us.
Thank you.